Hey, what's up guys? Marty with ThinkTank. Thanks for joining me today because today we've got something pretty unique. See, for the last couple of years, we've really enjoyed putting on events at breweries. We invite prospects and customers to come and join us for a very casual event. But the topic that we cover is very interesting because it's something that a lot of brokers don't share with their clients. The reason brokers don't want to share this information is because of misaligned incentives. You see, this information actually takes money out of brokers' pockets a lot of the times, and brokers don't like that. What we've been sharing at these events is what is called alternative funding options. So these are funding options for your employee health insurance that are different than the traditional health insurance that most people are familiar with. Now, these alternative funding options are not right for every group. For example, high-risk groups that are exceptionally sick may not be a great fit for these alternative funding options. But from our experience, a vast majority of groups can fit in very nicely into one of these options that we're going to go over today. So let's dive in and review some of these alternative funding options, and you can decide for yourself if any of them might fit your company. All right, so let's dive in here. So I'm going to run through this a little bit faster than we normally would at a live event. But if you do have any questions as we're going through this, feel free to make a comment in whatever platform you're on, Facebook, LinkedIn, etc. And we'll be sure to get back to you as soon as we can regarding any of the topics that we're going to kind of go over quickly here today. But typically in our agenda at these events, we go over a few different things. We start with what it is that they want you to believe, exactly what are all the options for health insurance platforms, what are these alternative funding options all about, and then finally we wrap up with new items for 2022. So real quick here, what are the things that they want you to believe? And by the way, what we're referring to as they here is the traditional broker that's stuck in just offering traditional healthcare to their clients. There are way more options that are available, but in a lot of cases, the broker gets paid more for offering their clients traditional healthcare options, which is why they don't want you to see what these alternative funding options are all about. So they want you to believe that there are not very many options for small and mid-sized groups when it comes to alternative funding, that a single high-digit risk is not all that bad, that self-funding is way too risky, and self-funding is another name for alternative funding here, that carriers can't share any of the claims data with small employees, which is absolutely not true, as we'll find out here, and that you are in jeopardy of violating HIPAA if you know too much about your group, which is also not a true thing. So here's a quick chart as an overview of what all the health insurance platforms are. We go from fully insured to HRA, level funded, captive, self-insured, and we wrap up with a PEO. And what it's kind of showing you here in this chart is that fully insured is the most expensive along with the PEO, which we'll cover at a later date. But as you go to the HRA, then to level funded, captive, self-insured, the potential savings increase and your cost decreases. Now we say potential savings because you see on the right we have a healthy and sick kind of gradient there. So healthier groups have the most opportunity for savings. But for groups that are more and more sick, the potential savings start to decrease. So we're going to dive into each one of these different funding options to kind of go through what each of them is all about so that you can then make a choice if any of these options might be right for your group. So first we have fully insured. Now this is the most common and familiar group health insurance for many businesses. So this is great for companies of all sizes, 2+ employees. The cost, as we already mentioned, is the most expensive, and you have next to zero control when it comes to being fully insured. The pros of this is that we're all familiar with it. It's generally easy to get, and it's really just a set it and forget it, in the sense that you're just going to keep your fingers crossed until that next renewal comes and hopes that it's not in a double digit. The cons is that it's very expensive, that you have absolutely no transparency, so when you get that very high renewal, you have no idea what caused that renewal increase. So you can't project increases. It's hard to attack risks within this group because there is no transparency, and that trend is usually around 9%, and it can even get into those double digits. So now we're going to dive into what all these alternative funding options are. That was the traditional funding option that most brokers offer to their clients. These are the alternative funding options. And in these options is where you have the opportunity to save a little bit of money and have more control over your healthcare. So we're going to start with HRAs. HRAs are designed to give employees a little bit more choice and greater control over their healthcare coverage. So HRAs are popular with companies that have less than 100 employees. You're able to save a little bit on the cost here, and it gives you a little bit more control. So this is a very gentle step into a alternative funded world. Pros is that it allows you for additional flexibility. The premium savings typically outweigh employer reimbursement dollars, and it gives you a peek into utilization. In other words, there's a little bit more transparency into what's causing those increases at renewal time. The cons with an HRA is that it could take a little bit of additional extra work for the employee or employer. It's not transparent enough to make very impactful decisions. It can't project increases, and trend, unfortunately, is still around 9%. Then we jump into level funded, which is the next step towards a fully self-funded environment. So with level funded, it's named level because you pay the same level amount every month, and you get to receive money back when claims are less than premiums, which is awesome. So level funded is a great option when companies have 5 or more employees. You can see here that we're able to save another little dollar sign there. So the potential savings increases a little bit, and we have significantly more control when it comes to being able to have transparency and make guided decisions. So the pros is it can be 5 to 30% less than a fully insured plan. You pay back the maximum, so no extra expense if you run poorly. You can receive money or credit if you run well. You have transparency, so you know how much healthcare your group uses, and transparency is in the reporting finally. So the cons is that you typically need to be a healthier group, but it's not as healthy as you might think. And that trend is 6 or 7% compared to the traditional 9%. So we have a significant potential savings here. And this level funded summary here is an example of that transparency that you're able to get when you're in a level funded program. And the best part, the actual savings here that one of our clients actually received this year, $88,591, which is very awesome and a significant savings for this client. So continuing down the alternative funded path here is a captive. So captives are groups of like-minded employers who join together and share the advantage of being self-insured without the additional risk and volatility. So captives are great for companies with 50 or more employees. You can see the cost savings is a little bit more and the control is significant. So the pros is that it can be 5 to 30% less than a fully insured program. You become part of a larger purchasing body. You have a full access to claims data. You typically start cash flow positive. You know how much healthcare your group uses, and sharing of best practices with other like-minded employers can be very beneficial. Now the cons with captive is that there are a lot of options. There are barriers to entry. In other words, your group will need to be accepted into a captive. And it can require additional management if you don't have a team like ThinkTank behind you. And then finally here, we're on a fully self-insured plan. This is the ultimate control of your healthcare spend and the most potential savings. So self-insured is usually for companies with 100 or more employees. The cost savings can be extremely significant, and you have the most amount of control when it comes to your employee benefit options. The pros, they can be 50 to 30% less expensive than being fully insured. You pay the maximum, so no extra expense if you run poorly. You can receive money or credit if you run well. You know how much healthcare your group uses, and transparency is in the reporting, just as with the level and captives. Now the cons of being self-insured is that you do have a lot of options, and again, it can require additional management if you're not partnered with a team like ThinkTank. Now I really love this chart. This chart shows where the actual savings can come from. So you see on the left-hand side, we have fully insured. Now the cost of your fully insured plan is simply the total of all premiums paid. That's exactly how much you're going to be paying for your health insurance. However, when you're in a self-funded world and all of the alternative funding options are a different form of being self-funded to some extent, the actual cost of your healthcare is dependent on a few different variables. 1, you have administration and other service fees. 2, you have stop-loss premiums. And 3, you have the actual claim payments that you're making on behalf of your employees. So when you add all those up, it's typically less than what you'd be paying on a fully insured plan. Again, there are variables at play. It is dependent on how healthy your group is, but from our experience, the required healthiness of your group is typically not as high as you probably think that it would need to be for there to be a significant amount of actual savings that come through. And this is a great chart that shows what happens when you compound trend over a decade. So as you can see here, the 9% trend is the typical fully insured trend that you can expect over the next 10 years here. And if you are fully insured and paying $1 million in premiums today, you can expect to pay nearly $2.5 million in premiums in 10 years. Now, this is compared with the 6% and 3.7% trends, which are both alternative funded trend lines. And with both of those, you can see that the $1 million at 3.7% trend is still under 1.5 million, is that you're saving over $1 million in a decade by switching over to an alternative funded approach. Of course, we'll share with you a few of our case studies from clients that we've had here outside of Chicagoland. Feel free to dive in, and if you have any questions regarding any of these case studies, be more than happy to share those with you. And then finally here, some new items for 2022. First of all, ARPA and COBRA subsidies, what you need to know about these. And finally, the Biden administration's COVID-19 action plan, which you probably can find a bunch of information about online. But of course, we got to include it here because it is a significant difference going into 2022. But if you have any questions regarding the ARPA, COBRA subsidies, or this Biden administration action plan, feel free to reach out to ThinkTank. These are your tankers. The reason we call ourselves ThinkTank is that we're not out to fit you guys into a specific mold of an insurance platform. We want to work with you to think tank with you what is the best option for your group. So if you are curious about any of these alternative funded options and you want to learn more, please reach out to our team. Contact information is here, and we'd be happy to help in any way that we can. But thanks for joining today, guys. I know that was a really high level overview of what all the options are. But if you have any questions and want to dig a little bit deeper into any one of them, please feel free to reach out, and one of our consultants will walk you through them. Thanks.